All right, listeners, buckle up, because today we're diving deep into the mind of one of the greatest investors of all time, Warren Buffett.
Oh, yeah, this is a good one.
We're dissecting his classic 1989 letter to Berkshire Hathaway shareholders, a letter packed with timeless wisdom on business and investing.
You know what's amazing about this letter? It's shockingly relevant even today. Like, he could have written it yesterday.
Seriously, even decades later, Buffett's insights are spot on. And for a guy who's achieved a 23.8% annual growth in Berkshire's book value over 25 years.
It's incredible.
Yeah, he clearly knows a thing or two about building a successful business.
He does. But you know what I find really fascinating about Buffett's approach? It's not just about crunching numbers. He goes deeper, focusing on what he calls intrinsic value.
Intrinsic value. It sounds kind of mystical. What exactly does that mean?
Think of it like this. Imagine you stumble upon a vintage watch at a flea market. Maybe it's a little beat up, needs some love.
Right.
The price tag might be low, but its intrinsic value, its inherent worth based on history, craftsmanship, its potential could be through the roof. That's what Buffett looks for.
Okay, so he's searching for those hidden gems, businesses that are worth far more than their current valuation. It reminds me of his early cigar butt investing strategy.
Exactly.
Buying those undervalued companies and squeezing out one last puff of value.
Yes. He was all about those cigar butts early on, but as he explains in this letter, he eventually realized that approach had its limits.
Yeah, I bet. So he shifted gears. I'm guessing that's where the sainted 7+1 come into play?
You got it.
Yeah.
This is where we see Buffett's evolution as an investor. He moves beyond just hunting for bargains and starts seeking out those exceptional, wonderful businesses, the ones with true staying power.
Right.
And the sainted 7+1, well, that's his affectionate nickname for a group of these stellar companies within Berkshire Hathaway. These were businesses like Candies and the Nebraska Furniture Mart. They all shared these key traits: strong earning power, manageable debt.
Got it.
And this might surprise you, pretty simple operations.
Wait, simple operations?
Oh.
That doesn't sound very well, Buffett. I thought he was all about dissecting complex financials.
Oh, he definitely is, but he learned a valuable lesson along the way. Sometimes, the simpler the business, the easier it is to understand its long-term potential. He'd rather invest in a company he can wrap his head around than, say, some flashy tech company with a business model that's, well, a bit of a mystery.
So he's not afraid to admit even he has limits.
Exactly. And that's where Buffett's thinking goes beyond just the balance sheet. He stresses how important it is to find businesses with solid financials and a phenomenal management team. He even compares it to horse racing. He says, good jockeys will do well on good horses, but not on broken down nags.
So even the best jockey can't win on a horse that's past its prime.
Exactly. You need both a strong business and a skilled jockey, or in this case, a talented and passionate leadership team,
to win the race. And speaking of trusting the right people, Buffett had a pretty interesting experience with a guy named Ike Friedman, who owned a jewelry store Buffett acquired called Borsheim's.
Oh, yeah, Ike Friedman. What a character.
And I hear there's a story about a $20 million jewelry heist.
You're not going to believe this. So picture this. It's a Berkshire Hathaway shareholder retreat, right?
Yep.
And Ike Friedman, the jewelry guy, he strolls in with like $20 million worth of diamonds and jewels, just casually.
Wait, $20 million. Now you got to tell me what happens next.
So Ike, he's quite the showman. He puts all this jewelry in a hotel safe, then turns to Buffett and tells him it's not even really in there.
He was messing with Buffett. That's bold. I kind of love it.
It was all in good fun. And, this story, it actually tells you a lot about how Buffett invests. He's not just fixated on spreadsheets. He wants people he can trust, people with integrity.
Right, like Ike. Someone who might pull a harmless prank, but never betray that underlying trust. Kind of like those old school business deals sealed with a handshake,
Exactly. But, as much as Buffett values trust and integrity, he also recognizes even the smartest people, they can make some dumb decisions.
Oh, for sure. We've all been there.
And in this letter, he dives into one of the biggest culprits. He calls it the institutional imperative.
Institutional imperative. Sounds kind of ominous. What is that exactly?
Well, think of it as a force that can affect even the most successful companies, like a sort of corporate groupthink that sets in.
Oh, I've seen that happen.
Yeah, so companies get stuck in their ways, blindly copying competitors, or even worse, convincing themselves bad decisions are good ones.
It's like the company becomes its own entity, separate from the people running it, and starts making decisions that, from the outside, make zero sense.
You got it. And Buffett argues this imperative, it can be incredibly destructive. Like, He points to companies resisting change even when it's desperately needed, or they're mimicking rival strategies that don't even make sense for them, or justifying poor performance with totally misleading data. It's a recipe for disaster.
And the scary thing is, it can happen to anyone, right? Even seasoned investors like Buffett.
Oh, absolutely. He admits to falling prey to this himself in the past. But that's why he stresses recognizing it, questioning your assumptions, and being willing to go against the grain.
Have a little healthy skepticism.
Exactly. A healthy dose of skepticism and independent thinking.
I like it. And speaking of skepticism, Buffett definitely doesn't hold back in this letter when it comes to zero-coupon bonds.
Yeah, those zero-coupon bonds.
He seems pretty wary of them, even suggests some companies use them to, let's just say, get creative with their accounting.
He does. And you see, zero-coupon bonds, they can be a bit of a double-edged sword. Useful, but also easily manipulated.
Right.
Remember how we talked about the institutional imperative leading to bad decisions? Well, zero-coupon bonds, they can amplify that.
Because they make it easier to hide risk. Right.
Yeah.
You don't have those regular interest payments staring you in the face every quarter.
Exactly. They create this illusion of profitability, especially when paired with accounting tricks like EBIT, earnings before interest, taxes, depreciation, and amortization.
EBIT. Sounds harmless enough. What's the issue there?
Well, Buffett, he compares using EBIT to, like, a high school dropout, trying to impress a car salesman by saying, hey, look, I can totally afford these monthly payments. Just ignore the fact I have zero income.
Okay, that's hilarious and a great analogy. But seriously, why would anyone take EBIT seriously as a measure of a company's health?
Because it can paint a much rosier picture than reality, especially in the short term. Companies use it to make earnings look better than they are, masking potential problems down the road. And when you combine that with zero-coupon bonds, which let companies defer interest payments, you've got a recipe for trouble.
Like building a mansion on a foundation of sand, right? Looks impressive at first glance, but eventually.
Eventually, reality catches up.
Yeah.
Exactly.
Yeah.
Buffett, he uses this great analogy in the letter. He says, with zeros, one party to a contract can experience income without his opposite experiencing the pain of expenditure.
Wow.
It's like magic, but the kind where someone pulls a rabbit out of a hat, everyone's amazed, and then poof, the rabbit vanishes in a puff of smoke.
And you're left wondering where it went. So if these zero-coupon bonds are so potentially risky, why are people so drawn to them?
Well, they can be tempting, especially in a hot market. Companies see them as a way to raise money quickly, without impacting their immediate cash flow.
Right.
And investors, they're eager for those big returns, so they often kind of overlook the risks involved.
It's that classic short-term thinking versus long-term value that Buffett's always warning about.
Absolutely. He constantly reminds us that real, lasting success, it comes from those smart, disciplined decisions that stand the test of time.
Which brings us back to Buffett's own investing journey. He's so honest in this letter about his own mistakes and what he's learned, talking about his early cigar butt strategy and how he came to realize that, buying wonderful companies, even at a fair price, is actually a much better approach.
It's true. He even admits to missing out on some great investments because he was too fixated on those bargain basement deals.
Wow.
It's a good reminder that even the best investors, they make mistakes. The key is to learn from them and adjust your strategy, right?
Absolutely. And one of the biggest takeaways here seems to be about avoiding unnecessary complexity.
It's funny you should say that. He talks about focusing on those one-foot hurdles, the opportunities that are right there in front of you, the ones that don't need some Herculean effort to take advantage of.
It's so easy to get caught up in those complex problems, chasing the next big thing. Sometimes the simplest approach is the most effective.
He's all about simplifying, focusing on what you can control, tuning out the noise.
Love it. So we've covered a ton of ground today. Intrinsic value, the importance of strong management, those dangers of the institutional imperative, those tricky zero-coupon bonds. We even got to learn from Buffett's own investing missteps. What a ride. What would you say is the biggest takeaway for our listeners today?
For me, it's this. Warren Buffett's success, it's not about some secret formula or some complex algorithm, right? It's about a deep understanding of business, a commitment to thinking long-term, and a healthy dose of humility.
It's playing the long game, building that enduring value.
Exactly. And you know what? Even after decades of incredible success, he's still learning, he's adapting, he's refining his approach. He embodies that power of continuous learning.
It's inspiring, reminds me that we're all works in progress, always evolving, always trying to make better decisions.
Well said. Couldn't agree more.
Well, as we wrap up this deep dive into Warren Buffett's 1989 letter, here's a final thought for our listeners to ponder. What's seemingly obvious, yet often overlooked, principles are shaping your own decisions in investing, in business, even in life. Just some food for thought as you navigate your own journey. Until next time, keep diving deep.